Micron's post-market blowout earnings and forward guidance have injected fresh energy into the tech sector today, proving that the hardware demands of AI are still expanding. The physical limits of memory chips, not software promises, are now driving the next leg of this cycle. Let's look at the hard numbers. For the third quarter of fiscal 2026, Micron reported record-breaking revenue of $41.46 billion, absolutely smashing analyst estimates of $35.6 billion. Net income came in at $28.24 billion. The outlook is even stronger. Micron expects fourth quarter revenue to reach $49 to $51 billion, with adjusted gross margins hitting a massive 86%. These numbers confirm that the hardware demand from data centers is translating directly into massive cash flows. This growth is anchored by high bandwidth memory. Micron confirmed that high-volume shipments of its next-generation HBM4 chips have officially begun to leading AI platforms. More importantly, memory supply tightness is projected to persist past calendar year 2027, with no clear date for when supply will catch up to demand. The global semiconductor expansion is accelerating. South Korea's SK Hynix announced plans for a landmark listing of American depository receipts on the Nasdaq, targeting a July 10th launch. The company aims to raise up to $29.4 billion, what would be the largest ADR offering in history, solely to fund AI chip and HBM capacity. Physical chip integration has replaced traditional scaling as the primary driver of performance. This shift is highlighted by specialized packaging player Amkor Technology, which entered a strategic partnership with TSMC to provide advanced packaging capacity at its new Arizona facility, helping resolve a key bottleneck in the AI supply chain. While the semiconductor opportunity is massive, specialized suppliers face serious concentration risks. Amkor's business is highly dependent on Apple and Qualcomm product cycles, which account for 29.8% and 11.1% of its total revenue, respectively. Broad market dynamics are shifting. We are seeing a structural rotation away from the megacaps, with value stocks, midcaps, and the S&P 493 outperforming the broader S&P 500 index. This broadening comes as the Magnificent Seven names face valuation fatigue. In corporate software, the market's extreme pessimism toward AI disruption has created deep value entry points. Accenture is down 51% year-to-date, trading at a valuation that prices in a 9% free cash flow decline, even though its actual cash flows are projected to remain highly robust. Data center power requirements are forcing utility pivots. Sunrun, Tesla, and Renew Home announced a partnership to aggregate residential solar batteries and smart thermostats, creating a 16-gigawatt distributed virtual power plant. This platform will offer power to data centers to bypass long utility build times. In the income space, high yields are adjusting to rate cuts. 6th Street Specialty Lending reduced its quarterly base dividend by 4 cents to 42 cents per share, marking the first base dividend cut in its history. This reduction reflects the pressure floating-rate BDC portfolios face as interest rates decline. For 2026 portfolio allocation, the traditional 60-40 strategy is being challenged by extreme index concentration, with the top 7 stocks making up 35% of the S&P 500. Growth investors are shifting toward momentum and tech ETFs in their Roth IRAs, despite the Buffett indicator hitting a record 230%. Here is the watch list for tomorrow. Track Micron's post-earnings momentum and SK Hynix listing details for the chip trade. Watch Accenture for a value bounce, and monitor 6th Street Specialty Lending as the BDC sector resets yield expectations. Stay disciplined as we wrap up the month.